All right, so we're recording now. All right, and so what I was started to say is that this chapter is broken into three parts. There's the fixed assets, sometimes referred to as capital assets, sometimes referred to as property, plant, and equipment, or land, buildings, and equipment. And that's really what the textbook utilizes. Okay, is this land, buildings, and equipment. Then we talk about intangible assets. Okay, and those are things that you can't touch, all right? They're rights that you have, all right? We'll address that. And then there's natural resources. Natural resources. Those are things like gold mines, oil, coal, trees, all right, things along that line, all right? And so the chapter is broken up into these three. I think it actually does the fixed assets, natural resources, and tangible assets in that order, okay? However, when we're talking about fixed assets, it takes us through three different stages, all right? The first stage is the purchase. Our purchase of asset. Okay. And the purchase of asset is really easy, all right? The journal entry is, I should say, all right? So let's say we buy equipment. Okay. Equipment's an asset, it's going to be debited, and let's just say we paid cash. Well, the big deal with the purchase of these things is really what goes in, all right, to this amount. Okay. And the rule, all right, is the cost concept. All right. The cost concept says record it for whatever it took to get it into its intended use. All right. And so if we bought a piece of equipment, obviously, we're going to have the price of that equipment. Well, we also have the sales tax. Okay. Well, we also have the shipping. We also have the assembling. All right. So there's a lot of things that could actually go into the cost of that equipment. All right. And so there are lists, okay, of multiple things that you include, all right, in the purchase of those fixed assets. All right. Cost, or land, equipment, and buildings. Okay, and so you definitely want to take note. Let me see. I think I can find the summary page for that. All right, hang on. All right, it's on page 490. Okay, Exhibit 2. All right, Exhibit 2 walks you through what costs should be included, all right, in acquiring fixed assets. Definitely look at some of that stuff. By the way, from chapter 10 on, okay, you should be thinking of how questions could be asked in multiple choice format, because the final exam is all multiple choice. There are no problems, all right? And so, kind of gear your mind, if you can, all right, into how things could be asked, all right? And so that's the purchase of assets, okay? The second thing, all right, is the use of fixed assets, okay? Using fixed assets, really, what we're trying to accomplish is the matching principle, all right? The matching principle basically says we want to record the revenues when we've earned them, and we want to match the expenses when we've incurred them, all right? And so if you think about our classroom, all right, I know it's been a long time, all right, and we talked about this way back in chapter 3 when we did the journal entry, because what we're trying to do is we're trying to come up with the journal entry, depreciation expense accumulated depreciation, that's a P, all right, we're trying to come up with this number. Now, in the past, okay, they gave you that number. In this chapter, we calculate that number, right? But really what we're trying to do is we're trying to accomplish the matching concept. Remember, this was an adjusting entry, chapter 3, okay? And we were trying to accomplish matching the revenues and expenses. So think about it. If S&C didn't have that building, all right, we don't anymore apparently, or we don't have the use of that building. You guys would probably go to a different community college, all right? Probably LMC. Especially today, if it's snowing, all right, you guys wouldn't take the time, or you would not come and sit outside, all right, for an accounting class. However, if you were, going to LMC, all right, and they had a building, you would give them your tuition. See, that's the big deal. When we earn the tuition, we want to match the cost of earning those tuitions. And so the cost of that building, we want to match against those revenues. The cost of the equipment, we want to match against those revenues. Does that make sense? Okay. And so really we're trying to come up with, what is this dollar amount? Well, there are 3 ways to calculate the depreciation, right? The first way is the straight line method. Okay. 95% of people in the world, all right, use this because it's easy, all right, and the idea behind depreciation is it's systematic and rational, right? And so to calculate depreciation expense, okay, we're going to take the cost, right? And see, that's why identifying the true cost that we did up above is very important, because from that cost we're going to subtract our estimated residual. All right. Okay. Estimated residual value is what we think we can get for that piece of equipment or that building when we are done with it. And we're going to divide that, okay, by its estimated useful life. And these are usually referred to as in years. Okay, that's going to give us our depreciation expense. Okay. Now, the videos, we walk through the calculations of this. So I'm just giving you the equations, all right? And then, if you want to be able to apply those, go and refer to the videos or work the homework and whatnot, because you are going to have to calculate the straight line depreciation on the final exam and probably on the quiz. I can't remember, all right? The second method, all right, is this thing called the units of production. Okay, the units of production, very few people use this because there's 2 steps involved in this, all right? I guess the textbook refers to this as units of activity, all right? With this, there's 2 steps, all right? And so A is you first of all have to calculate the depreciation per unit. And that's very similar, okay, to the straight line method. We're going to take the cost, subtract the estimated residual. But in this case, instead of dividing it by years, we're going to divide it by estimated units. This is going to give us a rate. Okay. Then the second step, right, to calculate the depreciation expense, right, we're going to have to take that rate, right, and multiply it times the actual units. I heard my thing bling again, so I'm not sure if somebody needs to get into the class. Hang on a second. Stop share. Nope, I guess we just lost somebody. That's all. Gotta go. Kind of getting bored. All right, whatever. Okay. All right. And so with this, all right, why people don't use it, all right, is because there's this two-step. Right? And really the big difference is, right, over here, all right, is where we used the estimated units. Okay. And down here, okay, we use the actual units. And this will give us our depreciation expense. The third method, and the hardest one, truthfully, is the double declining balance method. The double declining balance method is referred to as an accelerated method of depreciation. All right. Now they don't really give you an equation for this. All right. But I made one up for you. All right. You can actually find the calculation of this on page 497. All right. But with the double declining balance method, the first thing we need to do is find out what the straight line rate is. Straight line rate. To calculate the straight line rate, you're going to take 1 and divide it by the estimated life in years. Okay. And so the example that they use, they have a 5-year life asset. Okay. And so, you just take 1 divided by 5, and that gives you 20, right? Or 20%. If it's the double declining balance, you multiply that times 2. Okay. And so we're going to use, all right, a 40%, right, rate in order to calculate this double declining balance. And so to get your depreciation expense, okay, you're going to take the book value, and if you remember, book value was cost, subtract accumulated depreciation, and you're going to multiply it, right, times the straight or the rate, or I should say the double the straight line rate. Okay. And so, this equals your book value. Okay. This is the only one of the 3 methods that does not use what's referred to as the depreciable cost. Okay. The depreciable cost, right, is this thing right here. Right, let me see if I can highlight it. This, how do you like those funky colors, is what's referred to as the depreciable cost. It's the cost that we're going to be spreading out, right, over the life of this asset. Right? And so those are the 3 different methods of depreciation. Like I said, there's a lot more discussion about that in the videos that I made. Right? We also talk about revising depreciation estimates. Okay, so again, you can look at that. The one area that I kind of felt like I didn't do a great job on were repairs and maintenance. Okay. Or I should say repairs and improvements. I did slap some of this in, I think in part 4. Okay, but basically, we need to differentiate, right, between a capital expenditure versus, okay, a revenue expenditure. Okay. The capital expenditure, okay, increases book value. Okay. And so this is on your balance sheet. Okay. Where revenue expenditure, okay, is just an expense, right? And that's on your income statement. Okay. And so a capital expenditure equals, okay, either improving the asset, okay, or extending the life. Okay, and so examples of this, and improving the asset, and we talked about this when we actually worked the problem, would be, putting a hydraulic lift on the back of a delivery truck. All right, so we had the delivery truck, we had purchased it, and then a few years later we add a hydraulic lift, something that helps load that delivery truck. Right, that would be improving the asset. Okay? In that case, we're going to add it right to the cost of the equipment. Whereas extending the life, right? An example of that would be, the one that my professor actually used. He's like, you put a new roof on your building, so that's going to allow your building to last longer. All right, he said, the revenue expenditure for a building would be painting it. Right, that's normal maintenance. Okay, but putting a roof on the building, well, that's a capital expenditure. It's something that's going to extend the life of that asset. Hopefully that makes sense to you. All right. Again, there are the journal entries and stuff like that I put in those videos. Okay. So that brings us to the disposal of fixed assets. Okay. And there's three ways to disposal. All right. There's abandonment, all right, and they just call it discarding. Okay. There's the sale, and then there's the trade-in. Right, and so the big deal here, right, is comparing, okay, your book value, and again, book value would be cost, subtract accumulated depreciation, gives you book value, okay, compared to, or versus, okay, what you received. Whatever you received. All right. So if you discarded something, obviously you didn't receive anything. All right. And so you could only have a loss. Okay. You could never have a gain. With a sale, all right. And I use this example. If you had an asset that had a book value of, let's say, $2,000, and you sold it, all right, for $3,000, you're going to have a $1,000 gain. However, if you had that same asset, all right, which was valued, book value at $2,000, and you sold it for $500, you would have $1,500 loss, wouldn't you? And with trade-in allowance, all right, the gains and losses are identified when you compare the book value against the trade-in allowance, okay, whatever you receive. So I don't know if you've seen those commercials for used cars or whatever, and they say, hey, push, pull, drag your old vehicle in here and we'll give you $3,000 trade-in allowance. All right, well, they probably just marked up their vehicles by $3,000. Right, but that would be a trade-in allowance. And so if your asset had a book value of $2,000 and they're willing to give you a trade-in allowance of $3,000, you have a $1,000 gain there. All right, so that's the disposal. And again, there's a lot more to this. Okay, you can find it in the videos. The next section, right, are natural resources. Natural resources, okay, kind of the idea behind natural resources are, you have a gold mine, or you have, a coal mine, or something where you're extracting a product, right, that's naturally occurring, okay, and you're pulling it out to sell it, all right? And so again, when we sell it, we have the revenue, okay, and what we want to do is we want to match the cost of purchasing those mineral rights, or the lease on the land. I don't know, what is it, that TV show called Gold Rush, where they're going up to Alaska and selling off their, or digging for gold and stuff like that. They had to pay to use that land. And so if they don't extract enough gold, they're going to actually lose money, right? And so, that's the whole idea. Okay. Well, with natural resources, okay, we actually, the method that we use to deplete deplete, okay, I don't know if there's an E on the end of that, all right, that's basically the same thing as depreciation. Okay, and so we use depletion, okay, versus the term called depreciation, right? It's basically the same thing. It's just you deplete a natural resource and you depreciate a fixed asset. All right. Well, under this method, we actually use the units of production, right? That I gave you the journal entry for that above, all right? And so you just have depletion expense and accumulated depletion, okay? And really what you're doing is you're coming up with the dollar amount. Okay. The last thing are intangible assets. Whoa, what is that? Okay. An intangible asset is a right, okay? You have a specific right. You obviously can't touch a right, okay? Okay, you have the right to do or use something, all right? Intangible assets, okay, are things like patents, goodwill, copyrights and trademarks, things like that, all right? And so a patent is basically you've created something, all right, something new, and to allow you to make money from your creation without other people, using your idea, you file a patent, okay, and that gives you protection of your idea, okay. That only lasts for 20 years, okay. Goodwill, all right, is when you buy another company, right, and excuse me, you pay more for it than the fair market value of their assets. Again, I run through all these things. I think it's in part 4. Okay. Copyrights, right, are when an artist creates something, and that protects them from for somebody else using it. And so, if you wanted to use a song, all right, in a commercial that you're making, you can't just use any song. You have to pay the artist in order to use that. That's what a copyright is. A trademark, all right, if you think about the Nike swoosh or a Coca-Cola symbol, those are trademarks, okay? These have unlimited lives. Okay. Okay. Except, truthfully, this one, okay? And I have, I have a little description about that in the textbook also, all right? Unlimited lives, which means we cannot amortize these, all right? And so when we are making the journal entries for these, okay, we're using the straight line method. And really the only one that we're going to be amortizing, okay, is this one. Because it has a limited life, all right, we can spread the cost of a patent, all right, over that limited life. And so the journal entry that we're going to record is the amortization expense, okay, and we're going to do patent. Okay. So unlike the previous assets or long-term assets, there really is no, you can't touch this, all right? So you can actually reduce the patent, because if you remember, a patent is an asset, normal balance debit. And so by reducing it, okay, we're going to just credit that. Now, I say this in the video, some businesses do use accumulated amortization, okay? But this textbook doesn't, which means on the exam, they'll just use amortization expense patent, all right? They're reducing this patent. And so know, okay, that depreciation and depletion, again, depreciation was for fixed assets, depletion was for natural resources. Those are amortizations, okay? Amortization just means to spread something out, okay? And so we use the terminology for the specific items: depreciation, fixed assets, depletion, natural resources, and amortization, right, for our intangible assets. But it's the same concept. It's the matching concept. We are trying to match, right, the cost of these assets against all the revenues that these things are generating for us. All right. The last bit, all right, in the text deals with the fixed asset turnover ratio, and really all that does is it allows you to see the efficiency of you using the fixed asset. All right? And so that is chapter 10 in a nutshell. Okay, I'm going to stop recording. If I can figure out how to do that.